Welcome back. I'm your host Tom Bruni and you're watching another edition of What the Ficc, the weekly show where we discuss the most important chart or theme from the fixed income, commodity, or currency space. In last week's episode, we discussed the emerging bull market in natural gas, what the drivers are, and how we're taking advantage of it in the market. If you missed that video and want to catch up, you can click right here. Otherwise, let's jump right into this week's topic, agricultural commodities. A couple weeks ago on the blog, I wrote a post about agricultural commodities, noting that we were nearing a long-term inflection point for the group. However, a lot of the components remain in trendless sideways markets, so we needed to remain very selective in how we played it. Before we dive deeper into the space, I want to take a step back and look at a commonly used benchmark for commodities as an asset class, the Thomson Reuters CRB Index. Now, with any index, we want to understand how this is constructed. So, it holds 19 commodities, but they're not on an equally weighted basis. Instead, it's roughly 40% energy, 40% agricultural commodities, 13% base and industrial metals, and 7% precious metals. So, if the bull market in commodities, or at least the strong run we've seen off the March lows, is going to continue, well, the agricultural commodity space, that remaining 40% that's yet to participate, really needs to get going. When looking at an index like this, it can be a little difficult to understand what's driving its behavior. In this case, we know agricultural commodities have done nothing for years, but how bad is it? To find out, we looked at an equally weighted index of these 10 commodities. And as we can see from this weekly chart, prices are actually nearing a long-term support level that's been intact for roughly 45 to 50 years since the 1970s. This is a major support level, and momentum is diverging positively as well. What this suggests is that although agricultural commodities have struggled for years, we're at a very logical level for a long-term trend reversal to take place. And given the strength we're seeing across the commodity complex, it wouldn't be a major surprise to see money rotate into some of the areas that have not participated yet. Look at things like corn and wheat that have done nothing for years. If we start to see these break out and trend to the upside, that would be a major sign that agricultural commodities are ready to participate. So, let's say you share this bullish thesis about agricultural commodities and think they're headed higher. How do you get broad-based exposure? Well, unfortunately, there are no ETFs or other liquid vehicles out there that allow you to own these 10 on an equally weighted basis. In other words, the chart I just showed you, while great for informational purposes, is not something we can go out and buy today. So we need to look at the next best thing, which is ticker symbol DBA. This is one of the more commonly used commodity ETFs out there, and the reason for that is it gives you broad-based exposure by owning all 10 of the CRB Index agricultural commodities. The problem is, it doesn't own them on an equally weighted basis. So instead, it has large exposure to areas like corn and soybeans, but limits exposure to things like cotton and feeder cattle. That's not necessarily bad, it's just something you want to keep in mind when you're owning this vehicle. Another way to gain exposure to these markets is by using individual ETFs or ETNs, like SOYB, which tracks the price of soybeans. The problem is, a lot of these vehicles are very illiquid, meaning they have wide spreads and don't trade a lot of volume. So if you're looking to gain any meaningful exposure in these vehicles, they're probably not right for you. And sure, you can gain exposure through the futures market, but managing a portfolio of 10 contracts, making sure they're equally weighted, and constantly rebalancing them and rolling them forward as your thesis develops, that's a pain in the ass. And most people aren't going to do it. It's not cost effective. And that's why most people look for ETFs like DBA that give you a close enough look at what's happening in the space. The last way we can benefit from this thesis is by buying something like John Deere that has multiple tailwinds. Not only will this company benefit from higher agricultural commodity prices, but it's already in an asset class that's trending higher. It's a stock. And what are stocks doing? They're going higher. As you can see from this chart, John Deere is behaving great. It just broke out of a massive 2-year base to new all-time highs. What does that do? That defines our risk on the downside and allows us to play this theme in an indirect way without having to worry about futures contracts, ETFs or ETNs that are illiquid, or any other method to gain direct exposure. The main risk here is that you're playing it through an indirect method. So by owning John Deere, what you're actually getting is equity market risk that wouldn't be associated with owning something like an ETF or an ETN that is directly based on agricultural commodity prices. So if stocks fall apart and the market rolls over from here and we get a new bear market, guess what? It doesn't matter what agricultural commodities are doing, John Deere is going down with it. So it's important to consider what your goals and objectives are to identify what is most reasonable for your portfolio. All right, that's all we've got for you today. If you enjoyed this episode, make sure to let us know down below in the comments section. We love your feedback. While you're down there, why not drop us a like and also subscribe so you don't miss any updates from myself or the rest of the team here at All Star Charts. Thanks again for watching, and I'll see you guys back here next time for another edition of What the Ficc.